right, welcome back. Today is Friday, June 24th. The markets are closed. My name is Patrick Dunuwila. Joining me today is Steve Strazza and Ian Culley of All-Star Charts. Let's get right into it because it was a good week for once. The S&P 500 snapped a 3-week losing streak. We rose about 6.5%. More importantly, we closed above those May lows and the VWAP from the COVID lows that we've been talking about. So that certainly is a positive development in the near term, but longer term, we're still down about 18% from the peak. So there's a lot of overhead supply to work through, but definitely some positive developments in the near term. Moving on to the Russell 2000, you guys know I love to watch this one. I think it's a better representation of what the average stock is doing, and more positive developments there. We reclaimed the 2018, 2020 low highs. That's a key level right around 1700 there, which is another huge short-term development. That little false breakdown there should get us back to that 1900 level, 190 in IWM. And that level coincides with the VWAP from the COVID lows there. So definitely an important one to keep an eye on next week. And that level there is around 1900, 190 in the ETF IWM. Moving on to the sector performance, 10 out of the 11 sectors closed higher. Energy was the only laggard. We talked about that one last week a lot, about how we could see some potential weakness in energy. And, as you can see here, as long as we're below that 79 level, that shelf of former highs, there's really nothing to love about the energy sector. Some of the strength this week, as far as the sectors go, was in consumer discretionary and tech, some of those risk-on areas that have been beaten up so much. It was a lot of those trashier stocks. And Steve, do you want to talk about that a little bit more? Some of the trash-led rally, if you want to call it that?
Totally. So, I mean, you're not wrong, right? The major averages finally had a good week. But when I look at trailing 5-day performance, like you said, we have tech, we have healthcare, cyclicals. I look at these sectors on an equal weight basis. All three of those groups almost up 10% over the trailing 5 days, right? So obviously, with them being some of the largest weightings, right, these big cap growth stocks in the major averages, that put a little bit of a floor in the S&P and the NASDAQ and the major averages this week. Problem is, while we're seeing some improvement there from, let's call them the worst stocks or the weakest stocks, we're seeing significant deterioration from the leaders, right? So, you know what I mean? Pick your players. Who do you want to put your chips on here? We need the leaders to keep leading, or at least hang in there. Energy is in bear market territory, 20, 25% off its highs in 2 weeks' time. So, the aggressive nature with which bears came in and hit the leaders. We talked about materials breaking down from a major top last week. They weren't able to repair that damage this week, right? So we have these two competing forces going on. When we're starting to see things thaw out, we're starting to see the weakest stocks carve out bottoms, find their footing. Meanwhile, the former leaders or the strongest stocks, are looking worse and worse with every passing day.
So, yeah, you have biotech here. What was it? The best week for biotech since, I think, the Trump election. So way back in 2016. I mean, I guess the question is, when I see this kind of the laggards leading, is that a good thing?
It's not a bad thing, right? So the laggards need to stop falling. That would be huge, right? So it's bullish that these stocks are finally finding a floor. What's not bullish is that the leaders, the floor is now dropping out of, while these laggards finally find their footing, right? So that becomes an exercise of, what do you weigh more? What does it mean if energy and materials, which have very minimal impact on the major averages, what does that mean if we're seeing these groups kind of catch lower and enter corrective phases, while maybe these weaker groups, which have much larger weightings in the indexes, start to find their footing? So it depends on kind of what you're looking at. Are you trying to invest in the best stocks? If you think those are energy stocks, probably not the best bet to make over the next couple months to even quarters, I would say. It's looking like sideways for a lot longer for energy, materials, commodity stocks, a lot of cyclicals. Now, when we look at, I love this chart, the quad pane chart. the major averages are making new lows, right? Yet some of the weakest stocks, you could see it in the S&P 500 in the top left, making new lows. Yet the weakest areas are carving out nice little multi-month bases, and a lot of them didn't even undercut their May lows. Chinese internet's probably the loudest example of that. Those stocks actually look pretty good. They're up 50% from their lows in March. But even if you look at some of these, secular laggards here in the US, ARC, XBI, which is biotech, the IPO index, looks very constructive. So no, it's not bearish, but boy, it would be a hell of a lot more bullish if this was happening in an environment where we weren't losing leaders.
Yeah. All right, so we got to talk about commodities here. The last 2 weeks have been pretty rough for commodities. They've been the leading asset class this year, but they corrected about 10% over the last 2 weeks. Big change of character. They're still in a primary uptrend if you look, but the uptrend that's been in place for the majority of 2022 was broken. So definitely some signs that momentum's waning in commodities. Ian, I know you look at commodities closer than any of us. So do you want to kind of share your outlook and which ones you're watching here?
Yeah, we were talking about copper last week. Big downside resolution. But yeah, commodities are vulnerable. They're definitely vulnerable.
It's not just energy commodities and copper and some of the metals. Like that weakness has definitely been noteworthy. But you're saying some of these ags too.
Well, yeah, the entire space. So a big question that we've been throwing around internally for a couple months now, since commodities stopped catching higher, is whether or not the correction that we're going to see was going to take place through price or whether it was going to take place through time. And up until a couple weeks ago, we were leaning towards time. And now it's starting to look like it's going to be price.
Because it's been like sharp declines. Is that what you're saying?
Yeah, the sharp declines. And what's really got me is the downside resolution in copper and how sharp some of the pullbacks have been in other base and industrial metals. And that's one of the big stories of the last year is that while these other base and industrial metals have been ripping higher and other commodity groups and contracts have been ripping higher, copper has just been chopping sideways. It's really just kind of been hanging in there and maintaining. Now, as all those commodities start to roll over, some of them really pulling back. I mean, when you look at the ags, some of the drawdowns we're looking at are like 20, 30%. Now,
yeah, I think all four of those are they're all off.
Right.
20% from their highs in a couple weeks. Go ahead. Sorry.
Right. I mean, is that's common. That's common for ag. So it's like, yeah, is it common? Sure. Is this what bull markets look like in commodities? Yes. Still, we have to give credence to that breakdown in copper.
What do you mean? Is this what bull markets look like? Like these sharp pullbacks? You're saying these sharp corrections?
Yeah, I mean, we talked about all these big explosive moves on the way up. It's the same on the way down. So we're starting to see that. I think the big question is, is it going to hit energy? And if you look at the stock market, it's telling us yes. I mean, all sectors were up this week except for XLE.
Yeah.
So, I mean, is crude going to break below 100 or 95? I don't know. I think it gets it back down there. I think it tests those levels.
Why don't you talk about, you have this great chart here of copper futures and 5-year break-even inflation rates. Could you kind of walk us through this one?
Right. So commodities are inflationary assets. They do well during periods of inflationary pressures, right? So you look at, off the COVID lows, commodities have been one of the best in the last year and a half, easily the best performing asset class, right? So what was going on during that time? Rates are rising and inflationary pressures were growing, right? So now that we're starting to see rates pause and we're starting to see the 5-year break even roll over and copper's breaking down, that's signaling that those inflationary pressures are starting to cool and ease, and seeing copper break down speaks to economic growth.
Well, so help me square this, because you're seeing all these commodities coming down that should ease inflation, right? But then on the other hand, there's really nothing bullish about copper breaking down, right? So how do you kind of interpret that?
Right. I don't look at commodity prices breaking down as something that eases inflation. I see it as a reaction to easing inflation, if that makes sense. Okay. So seeing the 5-year break even inflation rate break down, that tells me that the commodity correction is probably going to be steeper. It's going to be deeper. It's going to be one that's going to correct through price rather than one through time. That's the information that I get from that. And when it comes to copper, I mean, just seeing copper finally roll over speaks.
And it was a decisive move lower this week. We were talking about it last week. It was at the lower bounds of the range, but man, it really busted out of the lower end of that range this week.
It did, didn't it? I mean,
So I want to move on to one chart, because this one chart, it's been on my mind all week. I think David Zarling originally shared it this week, but it's Martin Pring's 6 stages of the business cycle, right? And when you look at a chart like this, you're like, so where are we, right? I'm thinking we're probably somewhere between in stage 6, maybe. What do you guys think? Where all 3 asset classes are going down? You have stocks, bonds, and commodities down. Steve, why don't you go first?
Stage 6, probably.
Stage 6. But it's interesting because, we're talking about bonds firming up a little bit. Do you think maybe we could be getting into a scenario where we're starting to see stage 1, or?
I mean, possibly. I think it's a little early to say. I mean, what do you think, Steve? I mean, if they can catch higher here.
I think this all goes out the window when we're in an inflationary environment.
So really? So the classic intermarket cycle from bonds, stocks, and commodities doesn't matter when we're in an inflationary environment.
It's just different.
Yeah.
Yeah. And obviously, it's not going to play out exactly to it. It's more of a framework, but I think that's a really good point, is you have to look at it in an inflationary environment versus a disinflationary environment. Like a lot of these things, like a lot of the kind of frameworks that we have.
We talked about it last week. I think, with this new inflationary environment, a lot of us who, are in our 30s or what have you, we haven't lived through an inflationary environment like this. We haven't been analysts for something like this. So while, intermarket analysis is a huge part of what we do at All Star Charts, I think it's time to forget a lot of what we've learned over the few decades and learn some new things. So, I don't want to cling too tightly to, intermarket relationships that I'm used to working. I think you want to follow price and then figure out what these new intermarket relationships are going to be. And just like we have with Bitcoin and the stock market today, those things were not nearly as, tightly linked as they are today over the past several years. That's a new thing, but now we're used to it and we use that information. I think there's a lot of situations like that with traditional intermarket relationships.
So is Bitcoin just another tech stock? Is that how you look at Bitcoin?
That's it now, and I was talking about that today on the crypto call, whether that's because there's just more institutions in Bitcoin now. So maybe the portfolio manager who's running the tech stock book, right? Or the software analyst is also covering Bitcoin. So when they add exposure to, their large cap growth stocks, they're also adding exposure to Bitcoin. Maybe that's why you're seeing that correlation strengthen. Maybe it has something to do with, finally interest rates really became the key driver of the price action in long duration equities and also cryptos. But you know what I mean? Maybe that's a higher rates type of story.
Yeah.
Again,
I mean, it's basically like the same pressures on both things, right? On stocks and Bitcoin, which is a long duration asset, like some of these tech stocks.
I can tell a really good story about that and make it sound really smart and great. But at the end of the day, it doesn't matter why. It's what is it? Well, what is that? The correlation's tight as hell. So let's use it for as long as that's the case. And when it's not, we'll move on and find new intermarket relationships that we can, use to gain insight into these trends.
Yeah, I think that's a great way to finish. We usually finish with Bitcoin, and look at that. It's holding there right above those 2017 highs around 19,000. Steve, would you interpret that as bullish information then? The fact that it's holding on, risk assets are holding on by a thread there, but what do you think?
You got to see Ethereum back above its equivalent highs. So 1,400 in Ethereum, then I'll feel a lot better about Bitcoin holding. Wouldn't be surprised if we come in Monday and Bitcoin's taken that level out. We've seen the Russell break, its 2018 highs. We've seen Ethereum take them out. We're seeing more and more tops, complete. So it's kind of like, is Bitcoin going to be the only one? Is Bitcoin the tell? And then the Russell and the value line and Ethereum repair all this damage? Right now, the weight of the evidence is suggesting Bitcoin probably follows.
Yeah.
So what does that say for the trash trade?
Probably rolling over, probably getting faded. The trash trade just had a great 7 days. That's a bear market rally.
Right. Right.
It's a pretty good one. So we'll see.
Well, guys, thank you so much for joining me and sharing your charts and thoughts. Really appreciate it. I hope you have a great weekend.
All right. You too.
You too. Thanks, Pat.
Thank you guys for watching. If you enjoyed the show, please click like and subscribe, and we'll see you again next week. Thanks.